What's up guys, it's Sebi here with Investing and Stuff, and today I wanted to go over some of the main ways that I analyze growth stocks, and knowing some of these aspects has allowed me to find several stocks that have more than doubled within the past few months and also to outperform the broader market by quite a bit. Let's check it out. Now, if you're new to all of this, usually stocks fall into one of these two categories. It's usually either a value stock or a growth stock. And traditionally, most of the ways that the analysts looked at companies were more suited for value companies. So those companies had a lot of physical assets under their control. So for instance, steel companies or construction companies that were popular many decades ago. However, nowadays, some of those methods may not be as suitable for growth companies because the world has changed a lot. And many of the same aspects that applied 5 or 6 decades ago don't apply anymore in the world that we live in today. Now, very quickly, I'll go over some of the main factors that are not as relevant for growth companies as they are for value companies. It doesn't mean that they're not important at all. However, they're just not as important. So the first thing that's not as important for a growth company is the profitability of the company and also the PE ratio. Now, the reason why this is not as important is because when a company is growing, they really shouldn't strive that much to achieve maximum profitability. They should probably strive to grow as fast as possible and to expand their product into the world, while obviously still controlling some of their spending. Now, the second aspect that is not as important is dividends. Now, in certain cases, this may actually even be counterproductive because if a company is still growing, you really don't want them to pay back a lot of their profit to their shareholders. Rather, they should probably reinvest a lot of that money into growing the company. However, it's a case-by-case basis. So for instance, in the case of Nvidia, they actually do pay a small dividend. However, that's probably fine because the payout ratio is less than 10. So really what that means is that they're only paying less than 10% as a dividend to their shareholders. So they're really reinvesting most of their profits, which is really good. And by the way, if you guys are getting some value out of this video, please consider smashing the like button for the YouTube algorithm. It really helps me out a lot and also helps support the channel. So thank you so much for doing that. Okay, and with that being said, let's jump into the main metrics that you should probably look for when you're analyzing a growth company. And the first thing is the revenue growth. Now, the revenue growth can fluctuate a lot depending on how mature a company is. Usually, most of the growth companies in their first few years grow quite a bit. It's not uncommon to see even 100% year-over-year revenue growth. However, as companies grow, it's normal for this to slow down quite a bit. So for instance, in the case of CrowdStrike, which is one of my favorite holdings, we can see here that the revenue pretty much doubles on a year-to-year basis. From 2019 to 2020, it's not quite 100%. I believe it's around 90%. So from 250 million to 480 million. And they haven't yet reported for the full year that ended in January of 2021 for them. However, it's very likely that they will still be at close to 100% growth, which is really fabulous. Another company that has probably the most insane revenue growth on the market today is Snowflake. So we can see that in 2019 they were doing about 100 million in revenue. In 2020 they more than doubled that to 260 million, and we don't have full data for the entire past year. However, it's not unlikely that they will actually surpass 100% year-over-year revenue growth. Now, just to give you guys a bit of context, this is really insane revenue growth. So most of the big companies are only doing about 5-10% per year. Some of the better companies are doing maybe 20-30%, but we're talking about mature companies there. So like I said, it's not unlikely if it's a smaller company that the revenue growth is really way more accelerated. Now, the second metric that you can use to judge whether a growth company is overvalued or undervalued or fairly valued is the price to sales ratio. Now, this is simply taking their market cap, so their valuation, and dividing it by their revenue within the past year. So we can see that in the case of CrowdStrike, their price to sales ratio is over 60. In the case of Snowflake, the price to sales ratio is actually ridiculous. It's over 100, and it's one of the biggest price to sales ratio on the market today. However, you could make a point that it's also justified by the fact that their revenue growth is probably the strongest on the market today as well. Now, the price to sales ratio is very important. However, I do want to make a clear distinction here, and here's the gist of it. The price to sales ratio is very, very different depending on the industry in which you're operating in due to the profit margins. So for instance, if you make a software product that works for 1,000 people, and now you're trying to expand that software product to work for 100,000 people, most of the cases, the costs to expand that software product are going to be very, very low. It's not going to be 100x. Now, in the case of electric vehicles like NIO or Tesla, for instance, or in the case of vegan food, let's say stocks such as Beyond Meat here, the profit margins are much, much lower in those industries. Because if you do scale from 1,000 cars to 100,000 cars, although you will save up some costs, you still need all of those physical components. So basically the steel parts, the aluminum, and everything that the car needs to function properly. Also in the case of Beyond Meat, let's say, you can't really scale from 1,000 burgers to 100,000 burgers and have the same cost, because really you're gonna need 100 times more food to produce those burgers than in the case of 1,000. Okay, and the next aspect which you're going to look into is product metrics. And the first important one, in my opinion here, is the user growth. So for instance, in the fintech video which I did just a few weeks ago, we looked at SoFi's user growth. We saw that they're adding new users at, again, almost 100% year over year, which is really insane as well. And this is very important depending on the product that you have. So if you're building, for instance, a social media app, it's very important that more and more users try out the product. Another important metric to look at is the subscription growth, which is sometimes also referred to as the annual recurring revenue growth. And one of the most important things about this is that if a company has a lot of subscribed customers, we can predict with a higher degree of confidence what their revenue is going to be like in the next few years. So if you think about it, almost all of the successful companies within the past few years employ a subscription model. We're talking about companies like, let's say, Netflix or even Microsoft. And another important aspect that's related to the subscription growth is the cross-selling potential. Now, many companies have multiple products that they may choose to bundle for their customers, and having most of your customers from a subscription model really increases the likelihood that they will in time use those other products, and then the product will become just stickier and stickier. Okay, and we're moving on to the last section, which are some story factors. Now, these are a bit harder to quantify, but some aspects to consider are, first of all, the CEO. So the personality of the CEO is quite important. Also, his or her track record, whether they are a vocal person, like let's say on Twitter, for instance, like the obvious example, Elon Musk, whether they care about sustainable energy or any of those types of trends, or whether they support the cause. And also what I would say is that you should trust your own judgment. Just watch some interviews of him or her and decide for yourself whether, in your opinion, that person is trustworthy or not. Another aspect to consider about the company is whether they are operating in a trending industry. So for instance, right now, obviously electric vehicles is trending quite a lot. However, you should bear in mind that just because these are hot industries right now, the stocks tend to be more expensive. Now, another aspect to consider, although this may be a bit more subjective, is whether that company has a B2C component, so whether they have a product or a service that regular folks like you and me use. Now, it doesn't mean that B2B companies cannot be successful. In fact, a lot of the successful companies have a massive B2B component, but if they also have a product or several products that regular users can use, it just makes the product easier to understand for most other people, which also increases the likelihood that that stock may become a meme stock or even a cult stock, if you will. Now, if you guys want to see an example of me analyzing one of my biggest holdings, which is CrowdStrike, I'll put a link in the description down below. And thank you guys so much for watching this, and I'll see you in the next one. Bye bye.